We keep going. Well, in this final lecture, I will guide you through the current landscape and emerging trends in digital banking and digital finances. And we are witnessing a significant transformation in how financial services are delivered and consumed. For example, digital banking adoption has reached unprecedented levels globally, with fintechs playing a pivotal role in reshaping the industry through their customer-centric approaches and also collaborative business models. And let me walk you through the key developments and innovations that are defining the future of banking. And let's go on. First of all, let's look at the current state of digital banking adoption. For example, the numbers tell us a clear story. For about 73% of all banking interactions now happen through digital channels. And this shift isn't just about technology adoption, it represents a fundamental change in consumer behavior, because what is particularly noteworthy is that retail consumers are reporting equal levels of satisfaction with both fintechs and traditional banks. And for example, our data shows that 41% of consumers are planning to increase their use of fintech products. And this indicates that we are not just seeing a temporary shift, but rather a sustained transformation how people interact with financial services. And this adoption trend is particularly important for you to understand as future financial professionals, as it will likely shape the trajectory of your careers in this industry. And hereby, I want to emphasize how fintechs have fundamentally changed the financial services landscape. For example, from my experience working with both traditional banks and fintech companies, I've observed two key transformative aspects. First, fintechs have introduced truly innovative approaches to financial services, creating value propositions that didn't exist before. For example, when we look at processes like account opening or lending decisions or payment processing, fintechs have simplified what we once complex and time-consuming procedures. And the second crucial point is the improvement in customers' experience. For example, fintechs have prioritized user-friendly interfaces and streamlined processes, forcing traditional banks to reconsider their approach to customer service. And let me give you a practical example. For example, remember how opening a bank account used to take days and required multiple branch visits. So now, thanks to fintech innovations, you can complete this process in minutes from your smartphone. And this transformation of service delivery is what will be explored in detail throughout this course. And now let me explain the significant restructuring occurring in the banking industry. For example, the emergence of fintechs has created 5 distinct cross-industry competitive arenas that I find particularly important for you to understand. And these include everyday banking, investing, complex financing, and mass wholesale intermediation, and banking as a service also. And what makes this restructuring particularly significant is the scale of opportunity it presents, because we are looking at approximately $20 trillion worth of potential value creation across these arenas. And for example, when I talk with the industry leaders, they often emphasize how this restructuring is forcing both traditional banks and new entrants to reimagine their business models. And you can consider how a traditional bank might need to adapt when fintech company can offer the same services with lower overhead costs and better customer experience. And this restructuring isn't just about competition, because it's about the fundamental redefinition of what banking means in the digital age. And I'll be referring back to these 5 arenas throughout the course, as we examine specific case studies and innovation. And looking at the financial data, I want to highlight the remarkable trajectory of fintech funding over a 6-year period. For example, the numbers are quite telling, and we've seen the increase from $19 billion in 2015 to $92 billion in 2021. And this nearly fivefold growth wasn't just about more money flowing in, but the number of deals also increased by 1.2 times during the period. And let me explain why this growth has happened. We had a perfect storm of factors, including accelerated digitization, especially during the pandemic, evolving consumer preferences toward digital services, and strong investor interest in the sector, and supportive regulatory frameworks in many jurisdictions. And for those of you interested in venture capital, for example, or fintech investment, these growth partners demonstrate how market conditions and consumer behavior can drive institutional investment decisions. And understanding these growth trajectory is essential because it shows not just where the industry has been, but also hints at its future potential. And now let me address what happened in the fintech industry during 2022. And for example, the market experienced a significant correction, which I believe is crucial for understanding industry dynamics. And this correction was primarily driven by deteriorating macroeconomic conditions and geopolitical events. And this impact manifested in several ways. And we saw a decline in both funding and deals across different fintech segments. And there was a notable slowdown in IPO activities and SPAC listings also. What happened and what makes this particularly relevant for your understanding is how it demonstrates the industry's sensitivity to broader economic conditions. For example, while working with fintech companies during this period, I observed how they had to adapt their strategies rapidly. And for example, many shifted their focus from growth at all costs to sustainable business models. And the challenging environment required fintech to demonstrate resilience and adaptability, which are qualities that remain essential in the current market. And this correction serves as a valuable case study in how emerging industries respond to market pressures. And now let me explain this cyclical nature of fintech funding and why it matters for the industry's future. And for example, based on my analysis of market patterns, fintech funding tends to follow predictable cycles. And the surge we saw in 2021, for example, was exceptional. And we are now seeing the industry return to the more sustainable long-term trend levels. And what I find particularly significant is that even during the 2022 correction, fintech still maintained a 12% share of total venture capital funding. And this percentage is quite telling because it signals that investors continue to see long-term value in the sector despite short-term market fluctuations. And for example, when I discuss this with industry veterans, they often point out that these funding cycles help separate sustainable business models from those that rely too heavily on easy capital access. And for you as a future finance professionals, for example, understanding these funding cycles is crucial. And now let me share an interesting pattern I've observed in fintech funding resilience during 2022 and 2023. And the data shows a striking contrast between early and growth stage companies. For example, early stage fintechs, particularly those at seed and angel funding levels, demonstrated remarkable resilience with a 26% increase in funding year over year. And in contrast, growth stage firms experience sharp declines of around 50%. And I find this divergence particularly instructive because it illustrates how longer maturity timelines can provide startups with greater flexibility during uncertain market conditions. And for example, from my experience analyzing startup funding partners, this trend suggests that investors remain confident in the long-term potential of innovative fintech solutions, even while say, being more cautious about later stage investments. And this understanding of funding dynamics becomes especially relevant when we consider how different stages of companies navigate through market uncertainty, which is a concept that will be valuable for those of you planning careers in fintech or, say, venture capital. And now I would like to draw your attention to how differently B2B and B2C fintechs were affected during this period. For example, looking at the B2B segment, particularly in areas like banking as a service or embedded finance and small medium entity services, we saw relatively modest declines of 24-26% in funding. And within the B2B space, for example, payments and lending sectors attracted the largest portions of funding. And what I find particularly noteworthy is the increasing B2B adoption rate. And from my discussions with industry leaders, this trend reflects a broader shift where companies are actively replacing their legacy systems with modern fintech solutions. And the resilience of B2B fintechs during this period suggests that enterprise customers are viewing fintech solutions not as optional upgrades, but as essential modernization tools. And for example, as we progress through this course, we'll examine specific cases where B2B fintech solutions have transformed traditional business processes and created new value propositions. And now let me share with you some compelling projections about fintech revenue growth. For example, the analysis shows that fintech revenues are projected to grow at 15% annually through 2028, and this is nearly triple the expected growth rate of traditional banking, and which stands at I say at 6% annually. And to put this in perspective, when we look at fintech's share of overall banking revenue, we are seeing a potential increase from 5% in 2022 to more than 15% by 2028. And for example, from my experience analyzing industry trends, this growth trajectory isn't just about market expansion because it represents a fundamental shift in how financial services are delivered and consumed. And for example, I often explain to my consulting clients that these growth rate signals are signals a deeper transformation in the financial sector where traditional banking services are increasingly being unbundled and reimagined by fintech players. And for example, for you as future financial professionals, understanding this growth pattern is crucial as it will likely shape the job market and career opportunities in the coming years. And now let me explain these revealing charts about the shifting geography of fintech revenues. For example, looking at the data, we can see a clear trend in regional distribution between 2022 and 2028. For example, while North America currently holds 48% of fintech revenue share, this is projected to decrease to 41% by 2028. And what I find particularly significant is the growth story in emerging markets, for example, and their revenue contribution is expected to almost double from 15% in 2022 to 29% by 2028. And For example, when I analyze these trends with my industry colleagues, we see this shift is reflecting the rapid digital adoption in emerging economies, often leapfrogging traditional banking infrastructure. And the implications of this shift are substantial because it suggests that future fintech innovations may increasingly originate from emerging markets driven by their unique needs and conditions. And for those of you planning international careers in fintech, for example, understanding these regional dynamics will be crucial. And now let me illustrate why fintechs still have significant growth potential in the banking sector. And for example, when we look at the current banking revenue landscape, we see that fintechs have barely scratched the surface of the total market opportunity. And what's particularly interesting is how market uncertainty actually creates unique opportunities. For example, in my experience analyzing fintech trends, I've observed that during uncertain market conditions, we typically see an increase in M&A activities. And this often leads to higher returns as stronger companies acquire undervalued assets. And now let me emphasize this point, because while some might view market uncertainty as a challenge, it actually presents strategic opportunities for well-positioned fintechs to consolidate their market presence through strategic acquisitions. And for example, based on our research, both public and private markets remain largely untapped for fintech growth, suggesting substantial room for expansion in the coming years. And now I want to draw your attention to some telling statistics about fintech's current market position. For example, when we analyzed the public market landscape since 2014, modern fintech IPOs have generated a market capitalization of $0.3 trillion. And now let's put this in perspective. During the same period, we have over 2,500 legacy financial services firms with a combined market cap of $11.1 trillion. And this stark contrast reveals something quite important about the fintech sector's potential, because the relatively small market penetration of fintechs in public markets suggests there is substantial headroom for growth. And for example, in my analysis of these numbers, I see this not as a limitation, but as an indicator of the vast opportunity that lies ahead for fintech companies considering public market entry. And this disparity between traditional financial services and fintech market caps represents one of the most significant growth opportunities in the financial sector. Well, now let me explain how the 2022-23 market correction affected different types of fintechs in distinct ways. For example, when we examine fundraising performance during this period, we observe a fascinating pattern emerging. And the impact varied significantly based on two key factors, like the maturity stage of the fintech and its market segment. And now let me illustrate this with what I've observed in the market, which is early stage companies in certain segments, particularly those focused on B2B services, and demonstrated remarkable resilience. For example, despite the challenging market conditions, these companies continued to attract investor interest because their business models proved more adaptable. And this adaptability was particularly evident in segments like embedded finance and also payment solutions. And what's especially noteworthy is how this pattern challenges the conventional wisdom that market corrections affect all companies equally. And based on our data, the fintechs that showed the most resilience were those that had already established strong unit economics and clear paths to profitability. And I also want to highlight a fundamental shift happening in the fintech sector right now. After experiencing a decade of hypergrowth, the industry has entered what I characterize as a new era of maturity. And let me explain what this means in practice. And the previous model of growth at any cost is being replaced by a more balanced approach focused on sustainable expansion and profitability. For example, in my discussions with fintech leaders, I've noticed a significant change in their priorities. And for example, cost management has emerged as a crucial differentiator between successful and struggling fintechs. And the most effective companies are those that have found the sweet spot, which is their remaining and managing to control their expenses while maintaining high levels of customer satisfaction. And this balance is particularly challenging, but absolutely essential because from my analysis of, say, successful fintech companies, I've observed that those achieving sustainable growth are the ones that have developed robust unit economics and clear paths to profitability before pursuing aggressive expansion. And also based on our research of fintech operations, approximately 80% of fintech companies are currently restructuring their operating models. And let me share what's driving this significant shift. And the primary focus has moved decisively toward establishing profitability and creating sustainable cost structures. And what I find particularly noteworthy is how this represents a fundamental change in the fintech mindset. And for example, from my analysis of successful transformations, the most effective companies are those that have managed to streamline their operations without compromising their core value proposition. And for example, when I work with fintech executives, I emphasize that this isn't just about cost cutting, it's about building a more resilient business model. And the companies that are executing this transition most effectively are those that have taken a systematic approach to reviewing and optimizing every aspect of their operations, from technology infrastructure to customer service delivery. And hereby, I would like also to emphasize a critical principle in fintech development, which is the importance of establishing a robust foundation before expansion. For example, when I analyze successful fintech companies, I consistently observe that those who excel are the ones who first master their core business in their home market. And this approach provides several key advantages. First, it allows for deep market understanding and enables refinement of operational processes and builds a stable revenue base. And in my experience, advising fintech startups, I've seen how rushing to expand before solidifying the core business often leads to operational insufficiencies and diluted market presence as well. And also, let me share what I've learned here, which is a strong core business acts as a springboard for future growth, providing both the financial resources and operational expertise needed for successful expansion. And this foundation-first approach might seem conservative, but it consistently proves to be the most reliable path to sustainable growth. And now, let me outline the recommended strategic approach for fintech expansion after establishing a strong core business. For example, when analyzing successful fintech growth partners, I've identified that the most effective expansion strategies follow a measured and value-created approach. And what I mean by this is targeting adjacent segments that complement your existing strengths and selecting geographies where your core value proposition resonates strongly. And for example, from my experience working with expanding fintechs, I've observed that success comes from thoroughly understanding both market dynamics and regulatory landscape before making any moves. And the key is to maintain the discipline to expand only when your core business provides a stable platform. And for example, while expansion opportunities may seem abundant, I always emphasize to my clients, for example, that each new market entry should be evaluated based on its potential to create sustainable value rather than just growth metrics. And now allow me to explain a strategic approach that might seem counterintuitive at first, and the concept of shrinking to grow, that is. And in my analysis of successful fintech transformations, I found that strategic divestment of underperforming assets often leads to stronger overall performance. And here's why this works. By divesting assets that aren't meeting performance targets, for example, fintechs can generate capital to reinvest in their high-performance segments. And what I've observed in practice is that this focused approach typically results in outsized returns. And for example, let me give you a practical perspective. When a fintech concentrates its research on segments where it has a clear competitive advantage, it can achieve deeper market penetration and better operational efficiency. And this strategy requires careful analysis and sometimes difficult decisions, but the data consistently shows that companies who execute this well emerge stronger and more competitive. And now let me share some insights about the strategic role of M&A in the current fintech landscape. And in the present market environment, M&A has become increasingly important as a tool for rapid strategic pivots. For example, from my experience analyzing fintech transactions, I've observed that acquiring capabilities through M&A often proves faster and more efficient than developing them originally. And here's a particularity that is relevant point given current market conditions. That is, with IPO markets effectively paused, many fintechs are turning to private capital raising as an alternative. And for example, when I discuss this with fintech executives, I emphasize that successful M&A strategies require clear alignment with overall business objectives. And for example, in practical terms, this means identifying targets that not only fill strategic gaps, but also bring complementary capabilities or market access. And the current dynamics make this an especially opportune time for well-positioned fintechs to pursue strategic acquisitions. And now let me address a fundamental aspect of fintech success, which is the necessity of continuous innovation. For example, when we examine the competitive dynamics between fintechs and traditional banks, innovation emerges as the key differentiator. And based on my research of successful fintech companies, maintaining this innovative edge requires constant attention and investment. And therefore, let me highlight an emerging factor that's reshaping this landscape, and which is generative AI technology. And this technology is enabling new forms of disruption of banking services. For example, from my analysis of current trends, fintechs that effectively leverage emerging technologies like generative AI are better positioned to maintain their competitive advantage. And the ability to rapidly integrate new technologies while maintaining service quality is becoming increasingly critical. And what I've observed is that successful fintechs don't just innovate for innovation's sake. They focus on developments that create tangible value for their customers. And now let me explain why talent acquisition has become a critical challenge in the fintech sector. For example, in our current tight labor market, the competition for skilled professionals is particularly intense. And for example, when I discuss talent strategies with fintech leaders, they consistently highlight that traditional recruitment approaches are no longer sufficient. So let me share what successful fintechs are doing differently. They are putting their company culture and mission at the forefront of their recruitment efforts. And what I've learned from analyzing effective talent acquisition strategies is that fintechs need a two-pronged approach. First, they must attract promising junior talent who bring fresh perspectives and digital native skills. And second, they need experienced professionals who understand both technology and financial services. And the most successful fintechs are those that have developed innovative talent strategies that address both these needs. And from my experience working with growing fintechs, I have observed that companies that effectively communicate their purpose and growth potential, they tend to have more success in attracting and retaining top talent. Well, now let me walk you through 4 essential rules that I have identified for achieving sustainable growth in the fintech sector. And the first rule focuses on building a stable core business, and this means establishing strong fundamentals before attempting expansion. And for example, when I analyze successful fintechs, I consistently see that a robust core business provides the foundation for all future growth. And the second rule involves programmatic M&A. And this means developing a systemic approach to identifying and executing strategic acquisitions. And for example, from my experience, fintechs that excel at programmatic M&A tend to outperform their peers. And also, the third rule centers on maintaining cost discipline. And what I've observed is that successful fintechs establish clear unit economics and maintain strict control over their operational expenses. And finally, the fourth rule emphasizes fostering an innovative culture. And this isn't just about technology, it's about creating an environment where new ideas can flourish while maintaining operational excellence. And these rules work together as an integrated system for sustainable growth. And now, open banking represents a fundamental shift in how financial data is shared and utilized. For example, when I explain open banking to my students, I emphasize that it's about giving consumers control over their financial data. And let me illustrate this with a practical example. For example, imagine you want to use a budgeting app. And with open banking, you can securely authorize that app in order to access your bank account data. And this enables the app to provide personalized financial planning advice, say, based on your actual spending patterns. And this secure data sharing extends beyond just budgeting. It facilitates account switching between banks, automated payment services, and even personalized loan offerings. And my research indicates that this technology is particularly transformative for small businesses, which can now access better financial products by sharing their transaction history with alternative lenders. And the key point to understand is that open banking is not just technological innovation, it's a structural change in how financial services operate. And now let me share an important development in the financial services landscape. For example, major technology companies like Amazon, Apple, and Google are strategically expanding into financial services. And what makes their entry particularly significant is how they leverage their massive existing customer base. For example, I want you to consider this. And these companies already have deep insights into consumer behavior through their core businesses. And for example, when they add financial services, they are not just offering another product, they are creating an integrated ecosystem. For instance, when Amazon offers business loans to its merchants, it can assess creditworthiness based on actual sales data. And similarly, Apple's integration of payment services into its devices also creates a seamless user experience that traditional banks find hard to match. And you should keep in mind that these tech companies aren't trying to become full-service banks. So instead, they are selecting specific financial services that complement their existing offerings and enhance their customer relationships. And also, in examining the cryptocurrency landscape, I want to highlight some significant projections for banking. For example, our research estimates indicate that cryptocurrencies could represent 1% of bank deposits by 2025, with a potential growth to 5% by 2030. And let me put this into perspective. And this shift represents a substantial change in how people store and transfer value. And for example, when I discuss this with a banking executive, they often express concern about two primary challenges. First, there is the complex matter of risk management. For example, cryptocurrencies introduced new types of volatility and market risks that traditional banking systems weren't designed to handle. And second, banks must address security considerations, particularly in areas like custody solutions and integration with existing banking infrastructure. And for example, for my students working in traditional banking, I emphasize that understanding these challenges is crucial for their future careers. And now let me share some significant insights about cloud infrastructure in banking. And from my discussion with bank IT executives, for example, the consensus is clear, which is we're seeing a major shift toward cloud adoption by the end of 2025. And I want to explain why this matters, because cloud infrastructure gives banks the ability to scale their services up or down instantly based on the customer demand. And you can think of it like having an elastic IT system that expands during peak times, such as tax season or holiday shopping, and contracts during slower periods. And this flexibility translates into significant cost saving compared to maintaining traditional data centers. However, I must emphasize a critical point that often comes up in my consulting work, which is security remains a paramount concern. And banks must carefully balance the benefits of cloud computing with robust security measures to protect sensitive financial data. And while migrating to the cloud, banks need to implement comprehensive security protocols, including encryption and access controls, and also regulator security audits. Well, and when I research banking transformation, I observe how data and analytics are reshaping personalized banking services. And to understand the significance of this shift, consider how banks traditionally offer standardized products to broad customer segments. And now, with advanced data management capabilities, banks can analyze individual customer behavior patterns and transaction histories, also, and financial goals in order to provide truly personalized recommendations. And for example, in my work with the banking executives, I've seen how this translates into practical applications. For example, a bank can now detect when a customer's spending pattern suggests they might benefit from a different type of account, or when their savings behavior indicates they are ready for investment products. Or these personalized insights enable banks to transition from reactive service providers to proactive financial advisors. And the key to success lies in how banks manage and analyze their vast data repositories to create meaningful, individualized financial experience. And now let me explain how AI is fundamentally changing both front and back office banking operations. For example, through my research on AI implementation in banks, I have identified two key transformation areas. First, in the front office, AI enables highly personalized customer interactions. And let me give you a concrete example. When a customer logs into their banking app, AI analyzes their transaction history and financial behavior to provide relevant product recommendations and financial insights. And in the back office, AI automates complex processes that traditionally required significant manual work, for example. And for example, one of my banking clients reduced their loan processing time by 60% by implementing AI-driven automation. And the most valuable aspect I've observed is how AI augments human decision-making rather than replacing it. For instance, while AI can flag potential fraud patterns, human analysts make the final determination using the enhanced intelligence. And this synergy between AI and human expertise is creating more efficient and customer-centric banking operation. Well, and I want to walk you through how 5G networks and edge computing are enabling new possibilities in banking services. And the ultra-low latency of 5G networks, and we're talking about response times in milliseconds, makes previously impractical applications now viable. For example, in my banking innovation research, I've started several implementations where 5G enables real-time fraud detection at the point of transaction. And let me illustrate this with an example. For example, when you make a payment at a store, edge computing can process the transaction data locally and instantly flag suspicious patterns before the transaction is complete. And this same technology enables virtual and augmented reality banking experiences. You can imagine consulting with your financial advisor through a high-definition holographic interface, for example, and these aren't just theoretical applications because several banks in my research network are already piloting these technologies. And the combination of 5G's speed and edge computing, local processing power has created a new paradigm for banking services delivery. And now let me explain the critical developments in digital identity for banking. For example, from my analysis of global trends, more countries are implementing digital identity laws that leverage mobile devices for verification. And this shift holds particular significance for banking operations because let me share a practical case. When a customer opens a new account, instead of visiting a branch with physical documents, they can verify their identity through their smartphone using biometric data and government-issued, say, digital IDs. But however, from my work with banking regulators, I've learned that privacy protection requires careful consideration. And banks must implement robust data protection measures while maintaining compliance with identity verification requirements. And the key challenge lies here in balancing convenience with security, ensuring seamless customer experience while protecting sensitive personal information. And this balance becomes increasingly important as digital identity systems become more interconnected across different financial services. And that is drawing from my research in digital banking evolution, I want to explain why neobanks have gained such strong market traction. A neobank operates entirely through mobile apps without physical branches, for example, but it's their approach to customer experience that sets them apart. And let me share what makes them unique. For example, neobanks start by identifying common pain points in traditional banking. And for instance, they have simplified account opening to take minutes rather than days, but they have also reimagined basis banking functions. For example, instead of traditional account statements, they provide real-time spending insights with automatic categorization. And through my analysis of customer behavior, I found that This user-centric approach particularly resonates with younger generations who expect seamless digital experiences, and therefore the success of neobanks demonstrates how innovation in user experience can challenge established banking models even without the extensive infrastructure of traditional banks. And now, looking at the transformative potential of generative AI in banking, I want to share my significant findings from my research. For example, our analysis indicates that generative AI could create between 200 up to $340 billion in annual value for banking sector this decade. And let me explain how this translates to practical applications. For example, in customer service, generative AI can handle complex queries by understanding context and providing personalized responses. And for example, in operations, it can automate document processing and compliance checks with unprecedented accuracy. But however, I must address the workforce implications because through my consulting work with banks, I've observed that while generative AI enhances productivity, it also requires significant workforce adaptation. And banks need to rethink job roles and invest in reskilling programs, for example. And the key is here to view generative AI not as a replacement for human workers, but as a tool that allows banking professionals to focus on higher value activities like relationship building and complex decision making. And in my analysis of emerging banking technologies, virtual and augmented reality represent a significant shift in how customers interact with financial services. For example, let me paint a picture of what this means in practice. For example, imagine checking your investment portfolio through a virtual reality interface where you can manipulate 3D visualizations of your assets, or using augmented reality through your smartphone to instantly see property prices and mortgage options as you walk down the street. And from my work with banking innovation labs, I've observed how these technologies are moving beyond novelty to create practical value. For instance, some banks are using VR for employee training and complex scenarios, while others are developing AR applications that overlay financial information onto the real world. And the key advantage of these immersive technologies is their ability to make abstract financial concepts tangible and interactive, improving customer understanding and engagement with financial products. And also, when examining quantum computers' potential in banking, I want to focus on two key areas that emerge from my research. First, the technology promises game-changing advances in several domains. And let me elaborate on this. For example, quantum computing could dramatically accelerate AI model training, enabling more sophisticated risk assessment model. And it could also optimize trading strategies by analyzing market patterns at unprecedented speeds. For complex risk modeling, quantum algorithm also could process vast arrays of variables simultaneously, and something classical computers struggle with. However, through my work with financial technology researchers, I've learned that practical viability remains a future prospect, and the technology requires significant development in areas like error correction and quantum coherence before banks can implement it at a scale. And this is why I advise my banking clients to monitor quantum developments while focusing their immediate resources on more major technologies. And from my analysis of banking logistics innovation, drones are emerging as a solution for cash in transit operations. Also, let me explain why this matters. For example, traditional cash transportation faces significant challenges, particularly in remote areas or locations within difficult access. And Through my work with banking operations teams, I've studied how drone technology can transform this logistics. So you can picture this scenario, for example, instead of armored vehicle navigating challenges and terrain or congested urban areas, drones can transport cash directly between locations using optimized aerial routes. And the efficiency gains are substantial because what might take hours by road can be completed in minutes by drone. And the automation aspect also reduces human risk in cash transportation. And however, from my experience advising banks on technology adoption, I emphasize that successful drone implementation requires careful consideration of regulatory compliance and security protocols and even weather conditions. And now let me explain how crypto assets and decentralized finance are creating new funding channels in banking. For example, through my research on blockchain technologies, I've observed how stablecoins on public blockchains are establishing alternative fund transfer routes. For example, you can consider this example. Traditional international transfers typically involve multiple intermediary banks that can take days. And in contrast, stablecoin transfers can occur directly between parties in minutes. And for example, from my work with financial institutions, I've seen how decentralized finances transform and core banking functions. And it enables peer-to-peer lending without traditional bank intermediation, and automated market making for investments, for example, and also smart contract-based transactions. And these developments represent a structural shift in financial services, like one where traditional banking intermediation may become optional for certain types of transactions. And the implications for banks are significant also, as they need to adapt their business models to remain relevant in this evolving landscape. And in examining central bank digital currencies, I want to highlight how they represent a fundamental shift in monetary systems, because CBDCs enable direct digital exchange of central bank money without intermediary banks. And this differs from the traditional model where commercial banks act as intermediaries. And from my research tracking global CBDC initiatives, I have observed actually numerous countries moving beyond theoretical discussions to actual implementation. And for example, several central banks have launched pilot programs to test CBDC infrastructure and use cases also. And through my work, I have identified both opportunities and challenges here because, for example, CBDCs could improve payment efficiency and financial inclusion, but they also raise questions about banking system stability and monetary policy transmission. And the broader impact remains uncertain as we are still in the early stage of CBDC adoption. And for example, based on my analysis, central banks are taking measured approaches, carefully evaluating how CBDCs might affect their financial systems before full-scale implementation. Well, that is the end of our course, and that is the end of our lecture.